All right, let's get into the weeds. We talk some asset allocation, portfolio management with Jeff Klingelhofer joining us from Thornburg Investment Management, co-head of investments and portfolio manager of multiple funds and a long time at Thornburg. Jeff, thanks so much for being here with us this afternoon.
Yeah, it's great to be here. Thank you. Fun day with the Fed.
Yeah, so tell me kind of from your perspective, as you guys have a lot of income fund oriented, I think, interest over the last couple of years. People have been trying to figure out how to navigate this environment. What's changing right now on the margin in your mind?
I don't think really much is changing on the margin. I mean, what the markets are taking away from this is a very dovish message from the Fed. But the way I would frame it is I really think the Fed committed a policy error going back to late last year. So I would classify this as really the pivot to the pivot, where the Fed had told us coming into 2023 we were going to be on hold for a long while and they needed to see inflation durably come down. The Fed got overly comforted with seeing inflation come down, but a still very strong labor market. And today, the balance of risks is we are seeing growth come down, but inflation be sticky. So it's really a tough place forward for the Federal Reserve and for markets from here.
Is that why Jerome Powell is so quick to dismiss the role of financial conditions as being a force for sticky inflation? Because he would have to take some credit for that? Or blame, rather?
Well, I think that's part of it, but what surprised me out of this policy statement was that the Fed chose to taper its quantitative tightening program, right? You had two real stimulus measures to support the economy. You had rates that came down and you had QE. Now the Fed is reversing on rates. They're staying higher for longer, but they still chose to go forward with having QT taper off at a slower pace. If anything, I worry that we look forward from here and view that as something that the Fed also should have been more patient on.
Okay, shoulda, coulda, woulda, but right now, if he's in a tough spot and he is forced to eliminate cuts, which it seems like he's moving towards, the market certainly has moved towards that, but he doesn't want to talk hikes. If we're all the way full circle to higher for longer, Jeff, is that a relief or is that still going to apply a steady pressure?
No, I think it absolutely is going to apply steady pressure. And what we're seeing is it is working. The bite of higher rates is working, right? We see all over on the consumer side of the equation that consumers are, yes, they're consuming, they're doing their job, but they're having to dissave. They're having to actually take out outright debt, and they're defaulting on that debt. We see the exact same thing on corporate balance sheets where corporates are defaulting. Bankruptcies are rising. I think Powell's right. Growth is coming down, but they really should have been patient earlier this year because they themselves helped ease financial conditions. And being dovish in the press conference, I think, only served to reinforce that message.
So if you're operating from a baseline that you think growth is slowing, what's your response to a print like the one we got today from ISM where there's a 12-point difference between prices paid above new orders?
I think you're going to continue to see all of these forms of disparate data, which is normal in a turning cycle for broad GDP, right? Everything doesn't turn all at once, and so what we have to do is look through the noise. You have gross domestic income that's saying we're not growing. You have gross domestic product that says we're growing. You have the household survey that broadly shows that we're not creating nearly as many jobs as the establishment survey. And so I think it's just another data print that adds to investors having to look through the data, make their own assumptions, and then the starting place of markets that are overly complacent, in my view.
Does that mean we should be outright betting against stocks on an index level? Does it mean we should be betting against bonds? What's the combination? What works right now, Jeff?
Yeah, there's always very interesting names out there. So I think in bond land, to me, the answer is very simple. It's that investors aren't being paid to take that potential for future volatility, and there isn't a big cost to pulling back that volatility. So it's lengthening duration, it's shortening credit duration, it's building an interesting income-oriented portfolio. Stocks are a little bit more complex because the consumer has held in there, but where we're finding a lot of value is looking internationally, dividend-paying stocks, focusing on that income, focusing on stocks that are trading at much more depressed valuations that still have significant earnings growth ahead of them. right? Higher for longer is good for the financial sector. Companies that have already done all of their capex and now earnings are likely to inflect higher. Companies like Orange, both of those are paying BNP Paribas, paying 7% dividends and are really interesting from our view.
So then it sounds like maybe the solution is to kind of retool the equity part of the portfolio as an income-oriented, dividend-heavy type of approach. Does that also then mean you can keep some of your bond duration, or is this just a way to kind of replace bonds by skewing the equity component to income?
No, but I do think what it absolutely is go back to the basics on fixed income, right? Fixed income is meant to be the ballast to investors' portfolio. And a lot of what we're hearing from clients is a big question is, does fixed income work to hedge your equities? 2022 is painful, but we all knew the Fed had to raise rates eventually. That's where we are today. We heard from Powell that the next move is likely a cut, not a rise. And so I really think that fixed income should serve as ballast. So defense, focus on defense within the fixed income portfolio. And then on the equity side of the equation, it's picking the stories that really should hold up with durable earning streams and a moat around them.
Hey, last one for you, Jeff, because I know you're a bond guy at heart, I think. Correct me if I'm wrong, but one of the most interesting things of the last year was the bear steepener we got in 10s to 2s when growth was surprising to the upside second half of last year. If we go with a hypothetical, we get a bunch more ISM prints that look stagflationary like today's. What does that yield curve look like in a stagflationary environment?
I think it's really tough for bond markets to adapt to that environment. You know, one of the things that we're looking towards is we really want to play the belly of the curve, because in that stagflationary environment, even as the Fed cuts, what the Fed has done is created a very sticky form of inflation. So 10-year bonds might not come down nearly as much as the 2, 3, 4-year part of the curve, and that's where we really think fixed income is the most interesting. All
right, thanks for the details and the strategy, Jeff. Appreciate your time.
Thank you.
Jeff Klingelhofer is co-head of investments and portfolio manager at Thornburg Investment Management.